Okay, Chapter 8, Efficient Market Hypothesis. So the under the efficient market hypothesis, uh, investment returns performance is considered a random walk. Notion stock price changes are random. So the efficient market hypothesis basically says that prices of a security fully reflect all available information. So uh, the idea being that it would be impossible to trade on information and benefit from it. We'll see here shortly that it is possible to trade on information, and a couple of different examples here. So these are cumulative abnormal returns before takeover attempt for a target company. So we've got cumulative abnormal returns on the y-axis. We've got the days leading up to the announcement, and then so 135 days before, and then 30 days after. The key point here is that we look here the 15 days before. After that, before that announcement is made, so we can see that investors are beginning to take advantage of that information. Somebody knows what's taking place and is acting on it. Next slide shows a similar idea with regard to stock price reactions to CNBC reports. We've got midday positive and the diamonds with the solid line, and then the dashed line with the triangle, or midday negative. We start with midday positive. We can see that the stock price starts to go up in the few minutes before that announcement. The same with midday negative. Seems to start even sooner than with regard to the midday negative, like 10, 12 minutes before the announcement. But anyway, these are examples of investors profiting from information that they have. So this would certainly disprove at least a portion of the efficient market hypothesis. So competition is a source of market efficiency. Investor competition should imply that stock prices reflect all available information. Investors will exploit available information for profit opportunities. So, and when they do so, this will eliminate those. The competitive advantage certainly converge on insider trading, and it's pretty safe to assume that those charts we saw on the first couple of slides are examples of insider trading. So the efficient market hypothesis has three forms. Weak form: stock prices already reflect all information contained in the history of trading. So what this does, if weak form efficiency is, if markets are weak form efficient, then technical analysis, which there are, most people believe that technical analysis is a fool's errand. However, there are still people that do engage in technical analysis. They follow trends and so forth and act on those trends. And so the next form is semi-strong form. And it says that stock prices already reflect all public information. So this would be any financial information released, any announcements, anything that's in the public sector would already be reflected in the stock price. Strong form says that stock prices already reflect all relevant information, including inside information. I think we can conclude from the first two charts that we saw, that the strong form efficiency does not hold. So the last chart here, basically we can see that weak form falls inside of strong form. Semi-strong form, and then strong form encompasses all three. So again, the strong form being the most rigorous and fairly easy to disprove, because we can all think of examples where insiders have profited from information that they've held.